Hello, friends. Welcome to another interesting episode of Cafe Mutual YouTube channel brought to you by Nippon India Mutual Fund. Friends, equity investment is all about finding attractive opportunities at reasonable price. Last financial year was good for the equity market as it rallied across market capitalization. However, due to this, many fund managers find it difficult to find stocks which are available at a price lower than its intrinsic value. Considering this challenge, today we have with us Meenakshi Dawar, who is the equity fund manager with Nippon India Mutual Fund. Meenakshi has over 11 years of experience in equity research and value picking. Welcome, Meenakshi.
Thank you very much. Thank you, Nishant, for having me over.
So, Meenakshi, my first question to you is that what is your belief on value picking? How do you filter value stocks? Because for many people, for different people, the definition of value is different. So, what is your belief?
See, the basic principle of investing remains same that you need to find stocks which are at lower than their intrinsic value. Now, unlike in the growth investing, for a value investor, it is far more important to understand what is that business value, right? Because you are not buying those ideas for 1 or 2 years, which can typically be an idea for a growth investor. So if you're seeing any growth in particular sector, you can align yourself for 1 or 2 years. But in a value stock, it is far more important for you to understand that what is the core value of the business over a far longer period of time. And therefore, it is very important for you to understand the business cycles, right? So the idea of a value investor is that you buy good quality assets at a time which can be challenging for them, and therefore the long term value of the asset is not disrupted by these near term events or shocks that are happening. And that is how we try to focus on finding those ideas where the long term intrinsic value of the business is strong, the businesses are quite strong in there, but it is just that the near term challenges are there, therefore they are available at that gap of their value versus what you are paying for them.
Okay. So, Meenakshi, how has the concept of value picking changed over time?
See, that's a very interesting question. Unlike what we keep reading about value investors, historically, I think the business cycles were long enough for you to respond to, right? So you would get a lot of time for you to identify those gaps between what is the intrinsic value and what the market is pricing it at. But unfortunately, in today's world, market inefficiencies don't last for that long. Considering the depth that we have, considering the number of participants that we have in the market, um, therefore, so the window for you to identify those opportunities can be small versus what it was earlier. The second thing itself is the business cycles themselves are becoming shorter, right? So unlike historically where you would see that okay, a business is facing challenge, but that business will have a reasonable number of time to change its models, evolve with the changing dynamics, and then adapt to the changing realities. But right now, because there is the competitive environment around us, and we have what we have noticed is that business cycles have considerably shrunk for a lot of companies also. So, what you would assume, right, historically, that the businesses which are getting disrupted are now getting the disruptions is far faster. So, therefore, as a value investor, you have to be far more cognizant of the longevity of the business, that whether this business itself will be able to survive the disruptions that are happening around. So these are the two three things which has changed recently versus maybe what it was earlier.
Okay. So, Meenakshi, we have seen, in fact, in value research data shows that in terms of performance, the value fund category has lagged far behind most of the equity fund categories. So, in the long term as well. In such a scenario, Why do you think it deserves place in investment portfolio?
See, I agree that last 4 5 years have been challenging for a value investor. There has been a lot of reasons for this kind of behavior of stocks. First and foremost is that we have been struggling for growth for last 4 5 years, right? Because of whatever happening externally. As a result of it, the growth was very narrow, right? So there were only few companies, few sectors which were doing well. So even if you look at the listed universe and you try to analyze where the Nifty earning growth had been coming from prior to COVID, it is only the top 10, 15% companies which were contributing to that growth. So, and what was happening globally is that your cost of capital was coming down, right? Interest rates globally were coming down. So in this kind of scenario, what happens is that you have an appetite, right? Because your cost of capital is low, but growth is very concentrated. So you pay disproportionate amount to these growth companies. So as a result, we saw this strong polarization which happened in the market, that only 10 15% of the universe companies were also generating returns. But what has changed over last 1 year is that a lot of these value stocks, so-called value stocks, cyclical stocks, old economy stocks, they have again started seeing growth coming back. So, why this has happened is because historically, prior to COVID, a lot of policymakers were hesitant to put a lot of money behind growth. So, a lot of stimulus which were coming in the economy was more in the form of monetary stimulus. But now we see that there is a lot of fiscal stimulus, a lot of commitment from governments all over in getting these growth itself to be fairly broad based. So, you see what has happened in infra, right? We are talking about this big fiscal stimulus packages coming up, the infra package coming up. And if you see it in Indian context also, we are seeing this Make in India theme, which is picking up steam. And, government is ready to put money behind these packages. So as a result, a lot of these sectors which were not participating till 1 year back, we have seen very good revival in those names. You look at commodity names, you look at a lot of material companies, energy companies, a lot of these financial companies itself because of what is happening around. So because the growth is now becoming little more broad based. So even if you see a contribution to earning growth, right? So like 40 50% contribution to earning growth now is coming from the old economy stocks or the cyclical stocks, which had been always a drag on the earning. So because these changes are happening and this is happening after a very long time, value itself is gaining prominence, and therefore we are seeing this kind of performance coming back in value stocks. But still we are far from what the valuation difference between a growth stock and value stock stands currently as well. So it is not the so value stocks have started doing well. It is, but it's been only in last 6 7 months. But still, the gap between value stock and growth stock is still 50 to 100% more. So right now I think it is a good time for value stocks because of these structural changes that are happening. And secondly, some amount of inflation coming back in the economy also plays has a positive rub off effect on a lot of these value names.
So, talking about valuations, so despite the pandemic, equity markets have rallied across market cap last financial year. So, what is your view on the current market valuations of value stocks per se?
See, first thing is the we have to see what is the valuation for the broader market, and then maybe comment upon on the valuation of value stocks. So markets no doubt has rallied. The valuations have got re-rated. They are above their historical average, but you have to see it in context with what is happening around us also. See, last time when maybe market touched these kind of multiples, the liquidity environment around us was not as benign, right? So we have seen so much of stimulus, so much of liquidity coming in the market. Therefore, the cost of capital itself has come down. So cost of capital coming down, therefore the valuation itself tend to go higher. The second thing which drives your valuation is the equity risk premium, what we call, right? That is how much amount of risk you are taking over any risk-free asset when you invest in an equity as an asset class. Now, that risk itself has come down for a lot of businesses, right? Because we have seen one lot of commitment from governments and policymakers to make sure that these businesses survive. Second thing is that a lot of these businesses are coming out after a long period of downward pressures that they have seen on their margins and profitability. Therefore, all the weaker players are already out of the market. So now we have only the stronger, larger players which have survived and which are getting benefited from the upward revision in the cycle that we are seeing. So both these things, right? The risk premium coming down and your cost of capital coming down, and the way market is looking going forward also, that the commentary that we are hearing from policymakers, governments around the world, that the environment around us will keep getting support from them at least till the time we'll see full recovery from this crisis. So therefore, it warrants some amount of premium versus what it was historically seen. And maybe if you look at specifically between value of the valuation of the value stocks versus growth stocks. So as I said, growth stocks had earlier also re-rated quite a lot, and those multiples are sustaining. So if you see it in Indian context, there are a lot of these growth stocks which are trading at maybe 60 times, 70 times multiples, which are unheard of earlier, which is way higher than their average multiples, which is pulling the average multiple of the index also higher. If you look at value stocks, a lot of these cyclical stocks, what has happened is that they have definitely got re-rated, but they have a lot of earning support also, right? So their earnings itself have gone up after this crisis, and the multiples maybe are at the long-term averages. It is not that they have seen significant re-rating in the multiples because market is still skeptical about the longevity of this revival. So that gap is still reasonable. So if you look at average gap between value stocks and growth stock, that is still higher than what it would have been historically in the earlier cycle.
So, Meenakshi, your fund, Nippon India Value Fund, has consistently beaten its benchmark in 3 and 5 years. So, what are the three things that has contributed to this performance?
See, wha- in India, what we have seen among investors also, when we interact with other people also, a lot of people in India confuse value investing to valuation based investing. So they think that buying low PE stocks is the way for a value based investing, or that's how the portfolio will be constructed. See, from the very beginning, we have a very strong framework of of buying only those companies which are good quality companies, right? What happens when you do PE based investing is you end up buying cheap, although you end up buying cheap names, but the quality gets far more compromised, right? So for and therefore the portfolio returns on a longer term basis gets compromised because it's only good quality companies which survive and make get disproportionate pool of profit pools. So for us, it is very important. Number one is to identify good quality companies at bad times, right? So what we do is we have a very strong framework on identifying companies where management quality is good, their ability to withstand business cycles is very high, and we then buy companies at the bottom of the cycle, that they are facing near-term challenges and therefore their profitability is disproportionately impacted, and then play it through the whole cycle. So even if you see our holding period is fairly high. So we hold on to those names for 3-4 years till the whole revival of business takes place, and then those companies get re-rated again. So that has been significantly reason for us to do well. And second thing is, like I told you in the beginning also, that business cycles are becoming far shorter than what we had anticipated. So when business cycles are becoming shorter, there is very high probability that while doing this value-based investing, you will get into those value traps also. That you believe that these are cheap companies and they will be able to revive in some time, and but that revival never happens because the business gets so badly disrupted that earning itself becomes irrelevant thing to look at. So for us, identifying that what is the terminal growth of the business, whether this business has enough longevity, it will be able to survive cycles, that is very important. And at no point of time we invest in companies or which are so-called value trap companies, where they might look optically cheap, but on a longer term they tend to be most expensive investment that you will do. And the third thing is that we also do a bit of enough amount of diversification in our portfolio. So historically, if you see in Indian context, if you get too concentrated by saying that, okay, I want to do value investing, what happens is a lot of people then get concentrated into few sectors which are more cyclical in nature, which are more commoditized in nature. But for us, it is very important to maintain that diversification in the portfolio, and within those sectors, identify what those value companies will be, and which has really helped us in last 4-5 years.
So, Meenakshi, majority of holding of the Nippon India Value Fund is in large cap stocks currently. So these stocks can also be the part of growth funds as well. So what is your take on this?
See, first and foremost, market cap doesn't imply whether a company is a growth company or a value company. Okay, it is about what is the what is the near-term growth that the company is showing. So even a large company can be a value company, and large company can be a growth company, and small company, although typically people invest in smaller companies for growth, that can also be a value company. So we should not confuse with market capitalization in terms of what that company is, whether it's a value company or a growth company. So just to give you an example, if you looked at the market a year back, right, a lot of these sectors or companies which are large cap in nature, like commodity companies. In India, you have a lot of commodity companies which fall into these large caps, or financial companies by nature are significantly large, reasonably large in size. So they can all fall into a value basket. So it doesn't matter whether it is a small cap or a mid cap or a large cap. It just depends on the business cycle that it is in, whether it would be identified as a growth company or a value company. And secondly, from the portfolio construction point of view, we make sure that we do not take too much of liquidity risk in our portfolio. So therefore, we maintain a very healthy ratio of large cap and mid caps and small cap companies in our portfolio. So for example, 60% of 50-60%, 50-55% companies will be large cap in nature, 30-35% companies will be mid cap, you'll have 15-20% small cap. So you have a good mix of companies being represented from across the market capitalization.
So Meenakshi, how is Nippon India Value Fund different from other value funds in the industry?
Right. So first and foremost thing is that how we differentiate from others is that for us, value based investing is very different from valuation based investing. So we are not doing this low PE investing and then compromising on the kind of companies that we invest in, right? And if you look at in terms of our holding periods, our holding period is significantly large. So when we invest in a company, we always invest in a company with a view that we have to hold on to it for next 3-4 years, and we ride through the whole cycle of that company. And number three is we believe in that diversification has its own merits in the setup that we are in. So therefore, we have reasonably good mix of companies across sectors and also across market caps in our universe. So for when you are following a particular style, like in this case, you are following value as a style. So you're anyways building a portfolio which is more inclined to one particular style of investing. Therefore, you have to then make sure that you are not taking a lot of other risks in your portfolio, which can be by way of getting concentrated too much in terms of sectors or in terms of market cap. So we make sure that our risk adjusted return in the portfolio is far better. So we do not have any other significant risk that gets showed in the portfolio. It is only the style of investing that gets too much of importance and emphasis while building the portfolio.
So, Meenakshi, one last question. Why should distributors recommend Nippon India Value Fund to their clients?
See, first and foremost thing is that in terms of style itself, it's a unique style, right? So if you have a diversified fund in our portfolio and you add on to one more diversified fund, it doesn't add much value to the portfolio because most of the holdings are replicated in one fund versus other. Here you get an opportunity to diversify in terms of the style itself that you are taking an exposure to. Right. And second thing is that unlike other funds which are strictly categorized into categories of mid cap, large caps, small caps, where one fund managers cannot necessarily take opportunities which are available in other segment. Here we have that opportunity to diversify, and wherever we are seeing value emerging in the company, we are not anchored or we are not constrained that we should have only this kind of market capitalization. And thirdly, what we have done is allow is that it is very important for a value based investor to be able to sustain down cycles, right? Because in the up cycles, these companies come back very strongly and you make decent amount of money. You tend to do better only. It is your ability to handle down cycles that will differentiate you. So if you look at how we have been able to do in last 3 to 5 years, which have been very challenging for the value investor, because like I said, the way we anchor ourselves, the way we construct the portfolio, we have been able to very successfully demonstrate that ability that even in the down cycles, our portfolio will be fairly protected and will do reasonably well. And in the up cycle, obviously, you will participate in the sharp earning recoveries that is happening in these companies.
Okay. So with that, we have come to an end to this interesting session on value funds. Thank you so much, Meenakshi, for your valuable time and insights.
Thank you very much, Nishan. Thank you for having me over.
Thank you so much, all of you, for watching this video. Thank you so much. Bye.